I don't think it's a matter of communications policy. I think it's a matter of substance. And to me, the clear and present risk is the consequences, unintended though they be, of 10 years of suppressed and distorted interest rates with the attendant distortions in both the so-called real economy and especially in the financial economy, where leverage has been piled upon leverage.
So this is inevitable almost, this kind of negative
Well, it's
reaction.
certainly after 10 years of the lowest interest rates literally in the 3,000 years of recorded history.
So we get that you didn't agree with the policy before, but right now are they making a mistake?
It's not a question of agreeing with it. The consequences of 10 years of distorted interest rates are things that we can't always see, but which are nonetheless there. The things, for example, the distortion of the leverage loan market with this fine print that is meant to protect investors has been eviscerated or has been written down. Green investments proliferate because there are no interest rates. Interest rates are meant to measure risk, discount future cash flows, and set investment hurdle rates. When those things are absent or distorted, decisions in real time and real things are not as they might be. And exactly what is wrong will be revealed in time. Now, the stock market is a forward-looking indicator. The economy is not a forward-looking indicator, right?
You know, I would take the other side. I think he did thread the needle today. I mean, whenever you go into a Fed meeting and the market is weak, everybody's looking for the Fed to come in and stop and make an about-face of everything they did. And this December has been historically weak, as we know. So what did he say today? He said, okay, we're going to be able to adjust to different market conditions. The first market condition is, okay, if the tariff negotiations don't go well by March 1st, we're probably not going to go again. However, if we're just at the very bottom end of our neutral rate and we want to go maybe one or two more times, they're going to go again. But the direction of travel is the same. And what I've been telling people all along, and this is their 9th hike, it's hard to believe, but they've raised rates 9 times now. What I've been telling people all along, if they stop before they get to neutral, that's a bad sign.
But Phil, you could think they threaded the needle, but the market collapsed off of that interview. So the market didn't think that they threaded the needle. So there's definitely some type of misconception between the market and what participants think and the Fed.
Well, that's what I'm saying. The market goes into these meetings, if there's weakness, thinking that the Fed is going to make an about face. They're not traders, Steve.
But also the market reaction to a Fed doesn't always necessarily stick. I mean, there's a lot of knee-jerk reactions here, Phil. So are you saying this is an overreaction?
But Sarah, we started at 29.40.
Hold on, Stephen. Phil, continue.
So we would think that this is a perfect reaction to the market, to what was being said. But I have to stress that
the guys on the floor were yelling behind us, "Make this guy stop talking."
I know.
Powell was talking.
It was like the Will Ferrell skit on SNL. Yeah, exactly.
The S&P since the last meeting, since the last meeting in November, the S&P is down 9%. The Nasdaq is down 9%. The Russell is down 12.5%. They didn't thread the needle. This has become maybe what we all feared. Maybe it's become a political thing. There's no reason why he had to raise rates today.
Well, their mandate is not the stock market.
Steve,
he repeatedly said that inflation.
If they didn't move rates today, Steve, that would have been a big credibility shot.
He repeatedly said there was no sign of inflation, or the fact that reflation is tame, and they had wiggle room. That doesn't mean to me that he had to raise rates in December.
But they think they're still accommodated.
Let's go to Steve Leisman next, and then Rick.
Jim Grant talked about there being 10 years of distortion in the rate structure. And I just want to know, is it the considered opinion of the panel that the Fed ought to or ought not move towards normalization? And what you had is you had a massive fiscal stimulus come along. It allowed the Fed to raise rates and create a more normal structure with a modicum of pain that's going to be out there in the economy because of higher rates, but not rates that are high in any historical measure, either on a nominal basis or a real basis. We are still looking at a zero real cost of money. It was Jim Grant on our air last year who said that gold continues to out-yield some $7 trillion of paper around the world. So we're either in favor of normalization or we're in favor of continuing the skew that the policy has given to us.